Good afternoon or good morning, depending on where you are, or a good evening if you're across the pond. I wanted to thank you all for joining another AmTrust Title Insurance Company webinar series. The topic today is it really different this time? Sponsored by Steve Napolitano, Senior Executive Vice President of AmTrust Title. My name is Joseph Philip Forte. I'm the General Counsel of AmTrust Title. We have been approved to provide one CLE credit for this program this morning, just under the wire. And therefore, materials and forms to obtain credit will be found in handout section of your dashboard and will also be circulated to all after the program. A course code will be given during the presentation that you will need to include on your affirmation form for CLE credit. There will be no Q&A section today, but feel free to direct any questions after the program to Anuska Amparo at AmTrust, whose email you've received, and she will direct it to the panelists you mentioned. I'd like to start by introducing our panelists. First is Donald Sheets, who is Managing Director of Broadshore Capital. He runs their New York office, but he is in situ in Los Angeles at the moment. And Tom Nealon, who, by the way, was my office mate at Cadwalader in the beginning of the century, who is recently retired as the Vice Chairman and Director of Legal Affairs from L&R Partners. Today, we're going to try to make sense of what this downturn and recovery is going to look like and how it will be different from every prior one that we've experienced. So my question to the two of you to start this off is, how will this be different? Donald?
Well, thanks, Joe, and thanks for having us. Hopefully we don't overdo our time. There's more than enough to cover through some of these topic areas. We could probably go on ad nauseum. And I think a lot of us are getting a little fatigued on focusing specifically on COVID and the pandemic and what it means for all of us. But it's certainly the most relevant topic in terms of top of mind of how it's influencing most of our work. I would say that it's difficult to identify true paradigm shifts. And while what we're dealing with both on a human and personal level, as well as clearly a business level, is unique in our lifetimes, it's not necessarily unique to the world. And we have a couple playbooks that we've seen in history, none of which are perfect. There is probably going to be, if anything, rhyming versus replication of what's there. But what we have in front of us is effectively a catalyst that is playing out. There was immediate intervention from global central banks, and what is not necessarily unique but somewhat differentiated in this catalyst is that it's continuing to play out. It wasn't a singular event. It wasn't something that was an isolated terrorist attack like 9/11. It might be a little closer to what you might see as conflict, right? That might range over a period of time with an unknown end date and probably some stress points that happen along the way, not just once. And like we saw with GFC, there clearly were a few triggers over, now looking back, more of a condensed timeline. Maybe that was 9, 12, 15 months of play out. This is probably going to be a bit longer. But the reason I'm raising that is that it's while all of us have not necessarily dealt with a pandemic, there is a patterning relative to drawn out catalysts and how we adapt around that, both personally and professionally. So I'm not quite sure if it's a paradigm shift or if it's truly that different, but it will certainly have some common denominators and factors of what we've seen before.
So I think, Joe, what is interesting through any of these cycles, having all of us lived through a number of them, that in fact they probably in the end, even though while you're in the middle of them, you can't necessarily make this kind of judgment, probably have more in common than they do in terms of differences, particularly since ultimately it is really a property by property and, geography playing a big role and property type playing a big role. And it's clear there's going to be substantial fallout, as Don referred to, what the paradigm shift might be. We've been talking a long time about impacts on retail. Well, clearly, with all of the bankruptcies, it'll be interesting to see what that means come the end, let alone all of the online purchasing that we're all doing for everything from food to anything else we might need. So I think it will be clearly a period of time we're going to transition from, what the world was like 9 months ago or 10 months ago to where we are now. And I think that probably brings up one of the biggest challenges. It's unclear to all of us how long this will last. And more importantly, when will, property values really bottom out? Because I think in the interim, while people are trying to make decisions, whether you're a borrower, a lender, special servicer, on what to do with a particular property or loan, the lack of any real clarity regarding value will continue to be a challenge.
The CDC just said, could you hear me before that, or was I muted? I'm sorry.
We unfortunately, this is one of those classic Zoom or WebEx Dilbert moments. So, Joe, we didn't get the benefit of what you were just saying.
I was just saying that when my friends complained about the 2-year draft, my father would always say when he was drafted into the Second World War, it was for the duration. There was no end date in sight. And we're somewhere like that because only a few minutes ago, the CDC director just said that this fall we'll see a significant return if we don't sort of fall to a national policy of how we protect people. So it really is a medical issue, not an economic issue or the trigger. And the question is, if history repeats itself as it did in the 1918 Spanish flu, which began in America, there could be continuing waves. And if you've read the Barry book and Pale Rider, the other books that have been written on that flu, it came in successive waves that got more virulent. It's not going to be as bad as the 1348 bubonic plague, where 35% of the population of Europe was wiped out because they had no idea what's going on. But we do know what's going on. The problem is we don't have a policy so that every state is following the same routine. And that's the way the federal union works. But the issue becomes, I think, Tom, you hit on something. It's not only going to be by property type, et cetera. It is going to become by region or state. And that will get into the question of what, like New York not permitting people from 31 different states to come into New York. Unless you think they're not monitoring it. I had a sister-in-law that came in. She, when she flew in from Florida, they took her cell phone number and put her on monitoring. And the moment she left the house, she got a phone call and asked exactly where she was. The state troopers would like to talk to her. So it is Big Brother, but it's hard to figure out how we're going to get through this if we don't all act in unison. So we're then depending on something other than an economic recovery. We're depending on something in the development, which is supposedly happening faster than it's ever happened, of a vaccine or some other methodology to contain this. How do you view that when you have no end date in sight, and I mean none whatsoever, and you're trying to value properties? Because everything in a downturn turns around value. And if someone comes into you and says, well, we did this appraisal, of course, was all done based on January, February values because nothing else has been trading. How do you deal with that? How does a special servicer make a decision? How does an investor who's going to invest like you do in non-performing assets, Donald, how do you deal with that lack of certainty in the future? And I mean a very different kind of lack of certainty. There will be no leading indicators. It won't be hotels coming back at the beginnings because business is starting up again. They're probably going to be the last people to come back. So it is different in that sense. I'm not saying that the way the economics of it is not the same, but it is a different paradigm.
So, Joe, quickly from the special servicer end, needless to say, special servicers will be wary of taking any action that they think will really have altered the dynamic around that loan when they're not really certain that was the right direction to go. So I think there will be lots of, holding pattern type of situations where there will be accommodations, so to speak, by the special servicer while they try to see, what the horizon is offering. And I think that, will be probably the model for the foreseeable future, perhaps entering into, if they get to that point, short-term forbearances that may end up being rolling forbearances as they try to determine, okay, what's happening with this property and maybe what the appetite of that particular owner to continue to own that property and invest in it, particularly, given non-performing loans, being heavily influenced by how underwater a particular property might be at some point in time, and whether the interest of the sponsor to stay with that property goes away. But I think as a broad matter, special servicers will not have a great, desire or even have a sense of urgency about let's foreclose and take these properties back if there's an ability to, let some time go by and get a better sense of where this all may be going and how long it'll last.
Tom, I'd like to come back to special servicers in a little while, but I'd like to ask Donald, you and I have spoken about this a bit, but the trading of assets, problem assets, full assets, investors, what's going on in that market? Is it fluid? Is it frozen? What's happening?
Yeah, well, maybe stepping back for just a moment though on your question that Tom had started, which is where do you see clarity on valuation and how do you gain some conviction around assets today without knowing what the future holds? This is the same dynamic that happens in any crisis. And again, not to diminish the impact of what it is that we're dealing with. And frankly, we're pretty early in what's happening. We have many, many months of this cycle to continue playing out. And I believe we'll continue seeing periods of volatility, both up and down, going forward. The public markets clearly signaling something, and Main Street signaling something else. And there is, at least in my view, a fairly large disconnect between the two when the S&P 500 is nearly at its absolute high after hitting its incredible sell-off in short order in March, yet unemployment remaining fairly exaggerated and large verticals of the economy still severely impacted. So when it comes to valuation, we have different asset classes, Joe, and one that you instantly hit on were hotels. That's a daily revenue fluctuation. Other assets, you've got contractual cash flows in place, right? You might have an office asset, an industrial asset, a retail asset. I'm going to asterisk that and come back in a moment, that have some stickiness to a rent roll. And if you believe that there is credit and at least a period of time where those tenants will continue paying, then you're looking at an instrument or an investment that does have an element of contractual cash flow. You'll do some credit analysis around the existing tenancy. You'll do some analysis around what's going to roll. You'll look at what's vacant in the property and what's the propensity for there to be absorption of that space and at what rate and at what cost. And you can actually still do valuation work on that asset that has cash flow that's contractual, right? Estimations of cap rates or discount rates will remain subjective. And so I think a lot of investors won't just be looking at cap rates or these discount rates, but also really looking at the old fashioned, what's the basis per unit, right? i.e. what's the, if we're gonna acquire this asset or acquire this loan, what's our detachment point of X per square foot, X per unit, X per key, and really thinking about what that means in terms of discount to replacement cost, discount to what are some comparable sales that were leading up to this pandemic. There have been some sales through the pandemic. There aren't a whole lot of data points around that, but there are some. And getting some conviction around that basis. And is that enough to ride out this ambiguous period of time, right? So for a hotel, for anyone to consider running 12, 18, 36-month cash flow pro formas is merely a thought exercise, because that period of time for lodging, when you're marking to market daily, is highly subjective. It is in normal circumstances fairly subjective. It's complete speculation at this point. And it will come down to, do we feel good at $110,000 a key for this relatively newly built limited service hotel in a top 25 market? Does that feel okay? And do we feel like we've got some bandwidth with that basis? An investor would also need to factor in that carry cost, because between now and the next few years, an asset like a hotel that is cash flow negative, maybe it's cash flow neutral, perhaps it's NOI break even, not necessarily even paying debt service, but just NOI break even. Many hotels are not yet at that inflection point. Then there's a carry cost, and then you're increasing your basis every day, every month, every quarter, every year, and ensuring that you're being realistic about what that carry cost of incremental basis is going to look like. But it's not impossible to think about valuation. And again, at the during a period of time of the GFC, which is a natural point for many of us to look back to, there was a period of ambiguity around valuation, and it took some forward thinking and a little bit of judgment to begin transacting. And not that anything you buy during these periods of time is going to win, because certainly we're seeing some asset plays and some debt plays that do not look attractive, and we're wondering if these are going to be avenues for people to profit. But you generally, if you've been through these cycles and are able to have capital that is willing to invest in these times, you can come up with mechanisms to find valuation.
Well, isn't there an additional factor that you have to make in when you're making your appraisal that we didn't have in the GFC and several prior, and that is the acceleration as well as the deceleration of different property type uses. Retail was having its own little apocalypse, and suddenly, the grocery store, which was a despised property type, the folks at one of the chains in New York actually sold 6 of their defunct stores because people wanted to set up grocery stores, and other things like the social distancing and the requirements for how long it goes on with respect to situations in office space. How do you use the elevators? How do people get into the building? How many people are going to be taking larger space? I know that many of the hospitals that my wife is involved with through a hospital system, they've eliminated every single one of their conference rooms. No concept of having conference rooms anymore, maybe not in the future either. They could use space just for Zoom and have more people separated than they would otherwise have. So you have to somehow take into account the acceleration of some trends that were going on and the deceleration of trends. How do you factor that in when you're trying to figure out what the usage is going to be in the future? A thought?
Tom, what do you think?
Well, and I think you nailed one of the most challenging problems for special servicers because they have a loan that is obviously in place with a property, specific property and tenant, and roles that may or may not have stayed very static, most likely have not, and trying to predict around that, what may be occupancy 3 months, 6 months, 9 months from now, let alone what the cash flow has been like from these properties. And I think, those are the kinds of challenges that, people aren't going to be eager necessarily to say, okay, that's it, we're going to take this property back. They may have their hand forced by borrowers who look at that situation and say, I don't see this property coming back. I've lost, whatever, 10, 20, 40% of my cash flow. And some of those are major tenants that I don't see somebody coming back. And, the retrofitting of the costs of properties, when you start trying to factor all of that into it, I think is going to be one of the great challenges. I think it goes to one of the points that Don just made. It'll be certainly a situation where borrowers, entities that have capital will have, far greater flexibility in terms of being able to do something with an existing property or investing in a property that now becomes available because, the absence of capital. I know, right now servicers are really struggling to try to give a lifeline to borrowers by allowing them to use escrows and reserves to try to keep some form of debt service. But obviously that has can only be a limited duration. And then there will start to be significant defaults on large numbers of loans and properties. And, at that point in time, there's going to be obviously tough decisions that need to be made.
Yeah, and I think, Joe, building on that is, what's happened with this catalyst and what's happened in other cycles too, is that there may have been change afoot in some of these asset classes, clearly in advance of COVID. And to the point of what you're raising in retail, it's a very obvious example, is that this clearly accelerated the obsolescence of certain physical assets. And this, what was transpiring for the last several years in the regional mall space and within power centers and gravitating into grocery anchored retail was obsolescence for a style of distribution, right? People's shopping patterns and distribution patterns were changing, and they markedly changed, with this tipping point. So to borrow something from, Malcolm Gladwell, we had a tipping point probably back in 2012, 2013 around digital retail and the effect on bricks and mortar. And there's been a, ferocious debate from old school retailers and owners of those assets for the last several years that there still remains a reason to exist for those assets. And for some of the assets, yes, but I think for a much larger proportion now that will be accelerating on a much quicker timeline is absolute obsolescence. And, we will be stuck with physical stock that no longer serves its need as intended. All of us are positing over people's buying patterns and how that's shifted, but this is a further tipping point on what is effectively just a redistribution of goods, right? Goods sitting in a store on a shelf with somebody coming physically in to gather it versus procuring the good through a delivery mechanism, right? And that's effectively what's changed here. And will people still go to a retail center? Yes, the right kind of retail center, and there'll still be relevance for that distribution channel. But this was a further tipping point for that. I think on lodging, a lot of those of us who touch this space a little deeper than others certainly would have said that there was some functional obsolescence developing within the lodging space in advance of COVID. If you look at full service hotels in middle markets that were constructed between, let's call it the 70s and the 90s. These are 180 to 300 key, Marriott, Sheraton, Westin, kind of hotels that did not have much brand differentiation and effectively were in locations and or with physical plants that were outmoded and out of consumer taste, are going to be very much accelerated into obsolescence during what's playing out, because there will need to be the ability for people to get comfortable with, do we double down on this asset or not? Do we continue investing capital, and what's the ROI for that capital if we do it? And I think it's going to be a difficult conundrum on assets where physical obsolescence is much more accelerated today than being able to kick that obsolescence down, either through an asset sale or finding a new investor to recap the asset with, or finding the next lender to roll it into. There's going to be a lot of uncovering of obsolescence. I think it's a bit of a stretch to say that conference space is going to go away forever and that office is going away. But we can certainly look at a few variations of asset classes and see that the reason to exist is challenged.
And Joe, maybe if I can follow up on office, because I think Don brings up an interesting point. I think any number of businesses and enterprises have probably been somewhat surprised by their ability to continue to function when they no longer have basically large scale access to their office. So many offices are not, fully staffed or fully operational, but that doesn't mean that they haven't been able to operate remotely. And when you add to that, the concerns and the rightful concerns that many people have of being in an office, as you pointed out earlier, getting on an elevator, being in a crowded office and the like, I think, it remains to be seen exactly what office space will look like. I mean, obviously, most office buildings have long-term tenants, but it'll be interesting to see what long-term tenants, what their appetite is to come back on the same degree they were there before, and whether they're going to be looking for concessions or maybe downsizing their space, saying, I don't think we need quite that much space because we've found we can function quite nicely and our employees are much happier, not having to, because it's sort of a segue into something we haven't really touched on, is what the geographic fallout from the medical issue we're dealing with, whether large metropolitan areas where there's such a compression of people in a finite area, where then mass transit is the major form of transportation for people to get to and from work, whether that might be where the biggest paradigm shift may take place over the next number of years.
It's funny how you bring that up. There is a wonderful, webinar which you can get on from Cushman & Wakefield. I think I've shared it with you, Donald. I don't know if I sent it to you, Tom. It's called The Future of the Workplace. And it wasn't based on what their views were. It was a survey they did of their customers and clients worldwide. And I recommend it only because there are some very, very interesting statistics. Number one, the people who are adapting to and love remote working right now are the ones you wouldn't expect, the C-suite people. They are really thrilled with the idea. But more importantly, the people who are most distressed by it are the iGen, the centennials, Generation Z. They're tired of sitting on their toilet talking to people because their girlfriend is outside on a Zoom as well. So they're looking to come back, but it's not just that. It turns out that a lot of the younger people's complaint is they're not getting the culture of the company. So office becomes a place of culture. They're not networking with seniors and learning from people. They're not being able to watch people operate. So those are big factors. So the posit that was coming out was that, based on what you just said about transportation, that maybe the dynamic in the future will be a central core office in a major city, but for people who would otherwise be taking public transportation to get in the city, what was it called? The hub and spokes that the airlines did, that there would be remote remote offices that people could get to by driving, not getting on the railroad or a subway or in a bus. So there are factors like that that make changes. Don, you were about to say, I think?
I was going to also, while you're saying that, Joe, the impact that may have on multifamily of people saying, okay, fine, I'd want to be back in my office. I use my daughter who just went back to New York because she found herself having escaped New York to Miami, now saying I need to escape Miami to get back to New York. But she said, I want to live in a place where I can walk to my office. I mean, fortunately, people walk in New York, but I think there'll be a premium on people's ability to access, where they work without necessarily having to rely on mass transit.
I think that's, I really do believe that begins to be a big factor. Don, do you want to weigh in on public transportation?
It's since we're in the fog of war, if you will, or the fog of COVID, it's a lot of what feel like these paradigm shifts, will play out. Whether or not we have a vaccine, there will be adaptation around what's happening. So heaven forbid there is no vaccine. There will just be, as there always is, the remarkable ability of humans to adapt. And we already have a very large fixed asset base around which we've got to adapt. So right now we're in this middle zone of awaiting a vaccine, and then if vaccine works, there are some that believe that a flip gets switched over a period of time, and there's a resumption toward quote unquote normalcy. I think it's much more ambiguous in terms of how the adaptation looks if we can't find a vaccine, or or remains unproven for a period of time, or people are unwilling to accept it, which is going to be a question mark for a period of time, right? So we still have this fog that's going to be around, but on the, I guess, mobility of people front, even within many, let's call them suburbs around the country, they're highly urbanized, right? We've seen a remarkable resurgence of urbanization that does not necessarily mean the city center in the last 15 to 20 years. And you have what are creative clusters and walkable areas and amenity-rich options that don't require somebody to take, the one line in Manhattan to get somewhere. You can be in the suburbs of Chicago and it's highly, urbanized. In fact, more urban in some of these town centers than downtowns in some areas. You look at a market, strangely enough, like Detroit, and you have a number of suburban nodes, market that if you weren't familiar with Detroit, you'd probably be a little dumbfounded by, that have very amenity-rich, walkable, urban-like amenity bases. And the reason I'm raising this is I think that these areas have certainly blossomed in the last 15 years. And I think if I were to make a macro bullish bet, it might be on secondary markets that have amenity-rich suburban offerings, right? And you can point to a number of those where the cost of living is different. I think and again, not to get too philosophical on this, but it does influence the built environment. And it influences how do you value real estate and think about real estate. Clearly, it are going to be tastes and preferences. And in Manhattan, just by example, a lot of dual income couples have, there's been a constant battle of do we stay in the city or leave the city with our young children, right? This accelerant has certainly pushed many to explore amenity-rich, urban-like suburban options, right, in the tri-state area. I mean, the suburban New York housing market had been moribund to depressing for several years up to COVID. And those markets turned on a dime in terms of where the interest levels were, where depth of bids were, remarkable. Same thing happened in areas surrounding Los Angeles, in other major urban markets. So We can't ignore that. It's an anecdote, but there's proof behind it. You look at home sales in certain of these areas, and there's absolute data supporting that there is a taste mindset changing fairly quickly, to push for that. So I don't think subways are gone, right? And we will adapt. But they're just like the tipping point that happened in online retail in the 2011, 2012, 2013 era, when you started seeing that there was a real conversion factor of how people were re-choosing a distribution of their goods. There is an accelerating and potentially a tipping point in housing preference today, which will translate into how people commute and where people live and how they live. I would not make a massive, assertion that Manhattan multifamily therefore is dying or dead, but I would say that there is a bit of a tipping point that's happening here, where people are assessing cost of living, hassle of living, and what their built environment looks like, and what are they getting for what they're spending.
Education is another interesting area. Out in the Hamptons, I understand, there are a number of people have been renting more long-term and buying, and have notified their rental landlords in Manhattan they're going to break their lease because they're sending their children to school in remote suburban areas, no longer in Manhattan. There's just been a bunch of chatter about that recently. But turning more to the market itself in terms of the legal issues that are involved, there are a couple of things that are intertwined with the discussions we were having about valuation and the amount of also because of the moratoriums and stays of evictions, some of the things that are confronting both banks and insurance companies that service on their own or have third-party servicers and services and special services and CMBS and the funds. And that is two things. Number one, there is an issue because of the with the very rapid recovery that occurred, that a number of the services are capacity challenged. And what kind of incentives do they have to, bring up the people back to do these jobs? And the reluctance in some cases to ask for something when someone is going to be hit by a very large fee that's required. For instance, a CMBS deal, there was a lot of that chatter. There's a lot of misunderstanding by people who were calling special servicers and saying, I want a forbearance, and they'd say, send me your financial statements for the property, and somehow, oddly enough, most of those cases, either they never heard from them again or they withdrew their requests. But on the other side, there is the issue that I see about how do you determine, remember this, after what happened in the Depression and the collapse of the guaranteed mortgage obligation market in the 30s, and the laws of New York that reacted to that, the CMBS market has a requirement that the advances made by a servicer be recoverable, that you can't take the company down because they keep pouring money in it. And there's a possibility here of that happening. How do you know? And is there going to be an argument between the master and the special? Is there going to be an argument by the investors about a change in control because no one trusts the appraisal of the property? All of these things are sort of intertwined. And is there going to be the capacity to advance when the trust may not be getting money in? Well, I know 11 questions, but I think it's the discussion I want to have.
Well, I think it goes back to, I think maybe one of the most salient points and phrases that Don has used is we're in the fog, because right now it is a fog, particularly, and the fog affects different elements and, for that matter, different players in this market, meaning if you're a master servicer and you're saying, okay, management and the like doesn't want me over advancing on a particular, property or in a particular deal, depending upon, what the status of that deal is and how many more loans are left, is going to be very conservative in terms of how they view that. And that, potentially could set up, master and special, trying to make the case, no, this is a good expenditure. Maybe even in cases where it's now an REO saying, well, this expenditure, which will actually enhance the value of the property, is something that's essential if we're going to be able to liquidate the property without taking a monumental loss. So I think, that the fog comment is one that's going to be sort of overarching here of masters and specials, each not wanting to take any action that you can't undo, such as commencing a foreclosure, or even for that matter, taking back property, let alone assuming in the many states where foreclosure is a judicial process, exactly what that might be like. And can you imagine what the defenses might be like in those states? The poor lawyer who decides I'm going to do, quote, a garden variety commercial foreclosure. There may not be a whole lot of those when you factor in all of the issues associated with that. So I think it puts a premium on seeing if there's a way of, sort of treading water, maybe not holding the status quo, because there's nothing, about the status quo that seems to be staying the same. But I think there will be some premium around being able to do that as opposed to taking some permanent kind of action. But I do think masters are going to be very conservative because they've been down this, road before where you advance against valuation that, seemed, pretty safe, maybe 3 months ago. I mean, Don could probably speak to this better than I'm sure can find assets that a year ago, traded at or valuation would have been X. And then, it's probably, 40 or 50% of that number today. Well, that's a pretty significant drop, which obviously impacts the sponsor, but certainly impacts, a master who's trying to say, oh, okay, what do we think the recovery might be here on this asset when we're not sure they've hit rock bottom yet?
Yeah, you get into a little question, because I guess you could argue that not cleaning a facility, et cetera, the way the law requires, or the Department of Health in a town requires, would be waste, and you might be able to claim there's protective advances. But protective advances have always been a very limited group of items that you could advance for taxes, insurance, and that, a question becomes, do health advances that, dwarf the taxes and insurance payments, is that, going to be something that has to be done, or do you wait until you get to take it property over? I mean, then you wind up with properties that are not compliant with law. I mean, it's sort of just, it steamrolls.
Well, and when you mention that, bring up another, troublesome topic here is loss of rents insurance aren't turning out to be what they,
Right.
been in the past, because so many of them have an exception for, pandemic, which makes it a battle and maybe a question whether it'll be collectible. So, in contrast to a purely credit driven, the origin or impetus or whatever we want to call, or catalyst for all this being the coronavirus, does add some features to it that are certainly unique in all of our lifetimes.
Don?
Yeah, it's interesting. I mean, a solution, to the extent that there's a discord between masters and specials, are asset sales, right? So to the extent that we see a divergence of either interests or views between them, asset sales could be a natural solution to that. So I would posit that that may be a catalyst. I think that there is some conflict there since there's a fee generation business involved, and selling an asset is not necessarily the benefit of either of those two parties. So you'll see that perhaps become another exaggerated conflict in this cycle, like we certainly saw play out in the GFC, where average time in special servicing nearly doubled, for a period of time. So, just pointing that out as a solution. I think outside of servicing, but just in terms of, let's say, lenders generally, these assets can only atrophy for so long, right? And if you are a private debt fund, you tend to be capitalized not just with equity from your investors, but also with repo or warehouse financing of some variation.
And CLOs.
Yep, and you have other constituents involved in terms of how decisions get made on the workouts, how long do you atrophy an asset or forbear, and is there a there at the end of the day, and when does that come? And so we'll see different lenders / sellers of loans act differently based on, we've got some different stakeholders involved. On the servicing front, we'll probably have that natural conflict between wanting to retain assets for fees and disposing assets, right? So that's going to continue to be a theme that we probably see in servicing. Maybe some question marks around these advances, to your point, particularly for assets like lodging and retail that would need significant advances and would have significant question marks over valuation in the near term and midterm. So that is probably a front and center area. But then, when you look at these debt funds, there will have to be a motivation to find a solution, right? They are IRR driven, which means that time is not on their side. They've effectively conveyed to their investors that there's a return profile for that portfolio that they've originated. And every month, every quarter, every year, a loan atrophies, forbears, is garnering less interest income, if any interest income at all. It is a massive drag on portfolio IRR. And so there will be inherent motivations to find solutions for that, whether they're discounted payoffs, loan sales, workouts, restructurings, right? They have a unique motivator there, as well as financing facilities with a handful of banks that will probably also move the hand of control. And then you look at regional banks and other commercial banks, which is obviously a large set of the CRE lending universe. And, I have to say, a little bit as a taxpayer, I'm concerned when guidance from OCC, Fed, and FDIC out of the box was forbear and go and just, kick can. And in states like Ohio, where a governor came out, Mike DeWine, with guidance for landlords a month after COVID, in a pretty centrist state, it puts into play some interesting considerations where if depository institutions are just told to kick a can, that's not good for the US banking system. That sounds a lot like other banking systems that we've seen have paralysis. And what's been remarkable about the US banking system and the OCC and the Fed and the FDIC have been pretty active management of bank balance sheets. They either shut banks down, force merge banks, or effectuate asset sales through pressure, right? And we're not seeing that right now. So that may change 6 months, 9 months, 12 months into our fog, where it doesn't make sense to have bank balance sheets cluttered with atrophied assets, and we start seeing some change there. But right now, there's that's a kind of a tailwind for borrowers right now, is that there's a lot more acceptance toward forbearance in this near term than we might have expected, but that very well could shift.
And Joe, if I might just quickly on that, because I think it dovetails into another point that Don just raised, which is discounted payoffs, which are always a tremendous challenge for lenders and special services to make sure they haven't entered into some kind of an arrangement whereby, 3 months, 6 months, whatever later, somebody will come back to them and said, how did you ever let this asset go for X? Right. When, look what happened. And I think, probably also feeds into, it's not so likely that there will be a lot of those kind of transactions where valuation is so difficult to do, have any clarity unless some borrower comes in and offers something that a lender or a special servicer says this, has to be significantly above whatever their value point is and what they think the value point would be in some, short-term period. But I don't think you're going to find a lot of people who want to take that risk on either side, meet borrowers or special servicers.
Tom, moving on, one of the other, I just saw that it looks like Fannie Mae took back 2 senior housing portfolios, and one of the things that has been bouncing around is senior housing is very challenged because people are moving out and not moving in as fast as they were. And there's been a lot of new development in that area. I mean, it's a relatively new asset class, maybe 25 years it's been around, but that's one that people are watching because, the turnover in those is much quicker than not as quick as a hotel, but much quicker than typical residential. What you've been talking about, though, starts to smell a little bit like tranche warfare, except it's on the other side of the equation. It's not tranche warfare between the senior lenders and the mezzanine lenders and the B note holder. It sounds like there's going to be a little bit of distress between somewhat like what happened in ESH when the AAA holders wanted the property sold. The court decided they didn't have the right to push it. The special servicer was the one that could talk to the borrower. The other thing that's complicating things a bit is there are a lot of bankruptcies going on, you've seen, but there are a couple of aberrational cases. When you go into Chapter 11 and you decide to stay, the court usually requires you to pay rent. And there are at least 2 or 3 cases which are being challenged now, where the judge decided that the tenant didn't have to pay rent until the end of the bankruptcy, which of course made the landlord, and of course the lender therefore who's relying on it, an unsecured creditor who is at the back of the list if there's anything there. And the other thing that came out, which is very interesting, was in some of the senior housing cases, something that we all worried about in the early 90s, which really became an argument between lenders and not an argument with borrowers, recharacterization. And those cases are raising their ugly face in the senior housing area where people are trying to direct what's actually going on. So there are a lot of different legal theories floating around, the inability to get interruption, rent interruption insurance paid and all that kind of thing. And it's only making the cash flow much more difficult to understand. Tom, any thoughts?
Right. Well, no, or for that matter, in many cases, there's been minimal to no cash flow, which, goes back to what I was saying earlier about, there being a great willingness on the part of both masters and specials to allow, escrows and reserves to be used for some form of, cash flow in some cases, maybe for the property, or for that matter, to make payments towards debt service. But I think, we keep coming back to the uncertainty of when there will be, any kind of real vitality in lots of these markets and in lots of these properties. And, as we name certain types of properties, senior housing, has certainly any number of question marks around it that may not make it so popular, which, might mean it's an opportunity for somebody who's thinks they understand it and is willing to take on the risks. And, we, said earlier about the, staffing of special servicers to deal with all of this, that alone, when you think of the growing number of loans that are past due or in default, may push special servicers to say, we need to start doing something to clear this volume that's coming in and start making some judgments on which loans, which properties look like they might offer some ability to turn around and generate cash flow, and which ones maybe are best as a candidate for, a loan sale, if not a DPW. So I think, discounted payoff. So I think, we may find that given the sheer volume of what, specials are dealing with, they will find themselves saying, okay, what is every tool we have in the toolbox that we used, back during the credit crisis, and, let's dust them off and see what's out there, which may be even in terms of auctions and the like, saying we have, a large number of this type of property, or large number of properties in this particular geographic area. Maybe we see if we can bundle them up and try to generate some cash from it, which goes back to your point of whether senior bondholders who may say, okay, that's great, we're looking to get our principal back, and somebody else who's saying, well, I don't know if I like you, locking in those kinds of losses.
Right. Thank you, Tom. Don, do you want to wrap up on some of these issues?
Yeah, no, I mean, Joe, clearly some legal matters here will remain quite interesting and influential. I think you're right that there very well could be sympathetic benches on certain bankruptcy matters, foreclosure matters, eviction matters. I mean, it's cascading out there, and so precedent, while it may ultimately come back to being reliable and precedent worthy, there may be a fight to get there, and there may be a time related to the appeals process in some of these areas to get back to what we expect precedent to be. So that's going to be interesting on enforcement matters going forward. I think affecting certain property classes, multifamily is going to be more exposed, generically speaking, on some susceptibility to those matters than something like office, right? You may, or industrial, right? I think retail is going to probably find something in between, where as small businesses really do continue to suffer, are equated effectively to renters or homeowners, and there will be probably additional pain points and unexpected legal outcomes that morph out of there. I think the larger prism that at least I'm seeing at this point is that the strong message is from whether it's a governor like Mike DeWine or Andrew Cuomo or others, Gavin Newsom in California announcing some of these matters, is they're trying to effectively just bring the parties to a table. And it's a little bit like these elected officials versus judges, strongly suggesting, shouldn't you guys just settle? Why don't you guys go figure it out? We're gonna dangle out here that there could be some ambiguity on rights, right? So you ought to figure this out of court as much as possible. And if you come in court, realize that there might be a wild card, right? And the wild card might get reversed, but it might take some time and effort.
Time to do that.
And so I think that there's a forced hand happening of settlement in a lot of this. Not necessarily that a lot of it's going to stick, but it's providing a very unambiguous signal of settlement.
As I mentioned earlier, we are not going to have Q&A, but please, you can email Aniska Amparo at amtrustgroup.com and she will pass on your question to one of the speakers. Also, if you want to continue to hear Don's issues, among the items you'll be getting, in addition to an article I wrote about workouts, you'll get something called Sheets on Sheets. It's I guess it's bi-monthly piece that Don writes, which I've just read this morning, which are really very good, and I think you will enjoy. Finally, I would like to thank Steve Napolitano of AmTrust Title for sponsoring this program. I really want to thank the panelists who did a superlative job, and I'd like to thank you all for attending and being patient and listening to us. Thank you very much. See you on the next panel. Thanks.
All right. Thank you.
Bye.
Bye-bye.